Thank you so much for joining us today. My name is Alana O'Connell. I'm part of the marketing team here at Holistiplan. I am genuinely so excited to welcome you to our first webinar of 2026. Debbie and I had kind of a big brainstorming session at the end of last year, talking about feedback from you guys, our users, industry trends that we've observed, kind of the work that we feel most passionate about. And so this webinar is kind of the result of that. Um, One thing that I really love about Debbie is how intentional with and devoted she is to her work. So it makes me so happy to see so many of you, almost 1,500 people, signed up to be here today. So thank you so much for being here. If you are new here and you don't know her, Debbie is a managing partner and chief tax strategist at Carson Wealth. In addition to managing her own wealth management practice in Franklin Lakes, New Jersey, she is also a highly sought after speaker and teacher in our industry. Today, we are also joined by Holista Fan, Holista Pro, the one and only Greg Schulteis, a senior wealth partner at Carson Wealth. Before we hand it off to Debbie and Greg, I do have just a few housekeeping announcements. We are recording today's session and we will share it with you after the webinar. Please direct all of your questions to the Q&A. Debbie might ask some general polling questions during her presentation. If she does that, we will turn on that chat feature temporarily. But we do ask you to send your questions to the Q&A just so we can make sure that those get answered. I think that is all the housekeeping I have. So with that, I'll hand it over to you, Debbie.
Okay, so first webinar of 2026, huh? That's
We're
exciting.
here.
Yeah, that's exciting. Good. Well, welcome everybody. And I love that you're here because we want to start 2026 off on a really strong foot. And we have new tax legislation on top of the old tax legislation, on top of the previous tax legislation, right? So this is literally like we got a 10-layer cake. Greg, can you draw a picture of a 10-layer cake for me?
Oh,
Because
yeah,
that
let me just get on that.
Thank you, Greg. Because that's exactly what we have. We have this 10-layer cake, and every layer adds additional complexity. So thank God for Holistiplan to help demystify this, right? So thank you, Alana, for all the work that you've done in helping all of us, right? So with that, then let's hop in, Greg. So one of the things that we did in advance is we asked a number of you to complete a poll. And what we found from that poll is over 70% of you are still not sure about how OBBA affects your clients, and you're still evaluating the impact, over 70%. And that was our hunch, right? Even when we were putting together this presentation, our hunch was that we're still struggling with integrating OBBA because it was signed into law on July 4th. Then before we knew it, year end was here. We're just trying to get through it. And now we're in 2026. We're like, yeah, like maybe we need to be thinking about this a little bit more or a little bit differently. And so that's the idea behind today. But we also wanted to create something a little bit sexy for you, right? We wanted to create something a little bit exciting. Greg wanted to go with the boring, same old, right? 5 things you need to do in the new year. And I said, no, Greg, I'm so tired of that. And so Alana and I got together. We outvoted Greg. And we wanted to highlight why we think 2026 is special, because it's not business as usual. There are things that have happened over the last couple of years that make 2026 different and that we want to be paying attention to within the context of tax planning. So Greg lost the bet. Sorry, Greg. And so we decided to go with not business as usual, 5 major themes for 2026. And so let's think about what that is. So this next slide, Greg, where is your slide, by the way? Like, where is your picture? Where's your slide?
Oh, wow. Yeah, I was going to say, I don't know what you're referring to, but I understand what you mean. I'm
Yeah,
off somewhere over here somewhere.
that's
I'm
excellent.
sure of it.
All right, so let's make sure that you get your own slide next time. And by the way, when did you become a CPA? I mean,
Oh boy.
I love that for you. The only challenge I have is I worked really hard to get my CPA, and so I don't know how you did it because I didn't hear that you got your CPA. So I think that's really cool. So congratulations. You would just like went, sat, took it cold. Yeah, that's impressive. Okay. Because I was miserable for like an entire like 9 months studying for that exam. So anyway, I'm proud of you, Greg. You are a superhero. All right, what are we going to talk about today? OBBA. I'm skipping the last B. I don't have time for that. Okay. OBBA updates to consider, Secure Act 2.0, and the pitfalls of a large traditional IRA. Like more and more, this is what we're going to be talking about, right? Is these clients coming to you with large accounts, large taxable accounts, large large IRAs. And I call it the curse of the large portfolio, right? Because your clients have this curse now, many of them, your prospects have this curse. And when it's a curse, think about it, not because they don't have enough money, right? That's an accumulation issue. It's a curse because they need to have distributions done out of these portfolios and they don't know how, right? They're frozen, right? And so that's the curse now. The clients for years worried about accumulating enough. Now they've accumulated more than they ever could have imagined. So now their challenge is distribution, how to unfreeze those portfolios, how to thaw those portfolios without paying excessive taxes. And this is where you can provide so much value because this is going beyond, oh, I bought NVIDIA or Microsoft and I'm a genius, right? This is going so beyond that. This is tax planning that they cannot do on their own, right? They can't do it on their own. They don't have a list of plan. They can't do it. They don't have the training. 8 key strategies and tax implications. And then we threw something in there about interest rate decline because, oh, the head of the Federal Reserve, the Department of Justice is interviewing him. And so, there's some eyes on him. The idea here is that lower rates are on the horizon. And so what does that look like as we continue to lower rates? So that's what's up for today. Let's hop into OBBA. Right. And for some of this for you is a little bit of review. I get that because, we've been talking about this for 6 months and reading about this for 6 months. So some of it's review, but every time I talk about something, I try to add, the new twists or the new approaches that we're seeing, or maybe, now that you're thinking about this another time, you're thinking about it slightly differently and how you can integrate it into your practice, or what have you. And so I urge you to stay with us because yes, some of this might be partial review, but I think it's still helpful. And then we're going to get to some of the other newer topics in a little bit. Okay, so new rules, new strategies, and again, like think about this layer cake. Every layer is more complexity. There's no more spreadsheets here. No more like, oh yeah, I can calculate this in Excel. Like I literally will laugh in somebody's face when they tell me that they try to use Excel to do these calculations. That's just done, and particularly with OBBA and these phase outs that are all over the place. You can't possibly remember this. You can't possibly model this out. You need to have the software. So for those of you who have the software, congratulations. Probably one of the best investments you ever made. For those of you who don't, by the way, Greg, are these today? Is it we have our subscribers on for today, right? These are people who are.
This is could be subscribers, could be new people as well. Alana, I don't know
Alana,
if you
who
want
do
to.
we have? Who do we have with us
We
today?
we should have mostly people who are Holista Plan users. Kind of the baseline we gave is people who have a tax planning kind of infrastructure in place already, so we could go a little bit deeper. There might be some non-Holista Plan users who made their way here, so if that's you, welcome.
Okay. Yes. Thank you, Alana. I love that you're like the voice of God. You're like there, but not there. So I love that.
Yep, I
Okay.
just
So
appear.
yeah.
That's
So
me.
Greg, do not say bad things about Alana because then she will come back. Okay. Okay. Oh, we got the MVPs here. It says Kyle, right? And we've got David, who's another member with Holista Plan. Okay. That's great. I'd love to also hear from people who are not Holista Plan subscribers and what is taking you so long. Truly, I'd love to hear about that. Okay. And if you want to be anonymous, that's okay too. So good. All right. So we've got a lot of levels here, a lot of complexity, not just because of the legislation, but the way this legislation was drafted, because we're basically trying to make good on Trump's campaign promises. And the way we did that was all these temporary provisions, all these phase outs. And so that's what makes it even trickier. Okay. All right. Colin's got a question, but Alana, I know you'll handle that. All right. Let's go to the next slide. Because Greg admonished me today. He said, don't spend too much time on OBBA because he feels like his part is more important. And so permanent extension. So what we did on this deck is if the change is permanent, and that's small p written in pencil, pencil, then that's the beginning part of the slide. So you know it's supposedly permanent, which only means that it's permanent until we have a new majority, a new president, new people in there who are going to, want to write things their own way, right? So permanent with a small p. And if it's temporary, then the first word on the slide here is temporary. Okay, so we've got the permanent extension of the individual tax rates. What does that mean? Okay, phew, we breathe a sigh of relief, right? We breathe a sigh of relief because we were nervous that TCJA expiring, we'd go back to 39.6%. And all of a sudden, these tax brackets are not so favorable, right? So what does this mean for us from a practical perspective? So those of you who are on here thinking about 2026, let's think practical. What's practical then is we still have fertile ground to do planning, right? We still have fertile ground to do tax planning. So let's do it because there is a good chance that rates could be higher in the future. And I know we've been saying that for a number of years, but we still don't know. You still have tax policy risk. And so let's hedge against tax policy risk, and let's do some of that tax planning while rates are low. So that's number one. Number two is even though 37% stayed 37%, those in the 37% bracket are getting a haircut because their deductions are only worth 35%. So you only get a deduction like it's 35%, even if you're in the 37% tax bracket, right? And so a little bit of a haircut there, just something to keep in mind. Okay, let's go to the next thing, 3 ghosts of tax planning. So a little bit of a reminder here, right? Like, what are we really trying to accomplish? Yes, we like low rates. Yes, we like to pay less in taxes today. But what are we really trying to do? We're really trying to drive down our lifetime tax bill, right? Our lifetime tax bill, which may mean you push up today's taxes a little bit to drive down future taxes and to drive down taxes overall. So this is the name of the game, right? Name of the game. And again, Holistiplan is like a great resource in that because yes, we'll be modeling this out, but part of this also is possibly using your accumulation software, possibly using eMoney or Money Guide Pro or Income Solver, Income Lab, right, which is your distribution software, is looking at what those taxes are going to look like over a lifetime. And Holistiplan does help with the Roth conversion tool. And the point here is that OBBA, if we do some of this tax planning, it could drive up our taxes a little bit in the short term, right? It could do that, right? We might phase out of the SALT deduction. We might phase out of that enhanced senior deduction, right? Which are valuable, which are good for us. But if we're able to save hundreds of thousands of dollars in lifetime taxes, if we're able to set up our IRA and our wealth for the next generation to better inherit it, then maybe it does make sense to pay a couple dollars more in taxes this year. So you really need to do this balancing act, which you didn't have to worry as much about in the past. Sure, you had the IRMA Medicare surcharge that you're like, oh, you're going to pay a little more in a Medicare IRMA surcharge. And the client was like, what? And you're like, yeah, you're going to pay more this year. And then like 10 or 20 years from now, you'll pay less for 10 years in a row, right? And the numbers support, your recommendation here. Well, now we have a number of other, tripwires essentially that need to be disclosed when you do tax planning. Where are we disclosing them? Right up front, in red, in bold, in yellow, right at the top of the email is, hey, OBBA has these phase outs. And you might then end up paying a little bit more in taxes or not qualifying for some of these deductions. But our recommendation is to still move forward, with this planning recommendation. Okay. And so we've got to be sensitive. You've got to cover yourself, have that right up front in the emails. And then at the very end of the email, have those disclaimers. Go talk to your accountant. We don't know your exact situation. It could change, right? Because these recommendations are based on, 2024 taxes, right? So, a lot of moving parts here. You don't have a crystal ball. So you need to disclaim, you need to disclose, right? Disclaim, disclose. Okay. So that's the 3 ghosts. Let's keep moving here. So permanent expansion of the standard deduction, again, permanent, written in pencil. But what does this mean, right? What is this expansion of standard deduction? So remember, they doubled it from the TCJA. 90% of clients are taking the standard deduction. So what are the takeaways? What are the action tips? Number one, your clients and their tax preparers may have gotten lazy because they're all taking the standard deduction. Now, because of this enhanced SALT deduction, they might be itemizing again, right? We don't know what the number is, but some of your clients are going to be entitled to a $40,000 SALT deduction. That means they're itemizing possibly, right? So what does this mean? They need to start collecting receipts again. They need to start collecting receipts. They need to start engaging with their tax preparers. Many tax preparers are not going to be thrilled about this because they're like, oh, yep, standard deduction. Let's move along. I don't even have to meet with my clients anymore. And now it's like, maybe we need to have these conversations again. So work with your clients. particularly in this 1 or 2 transfer year, about what does that look to be itemizing again. This is going back to our standard blocking and tackling that we've been doing for decades. Does that mean bunching deductions? Does that mean like trying to take advantage of that medical deduction and exceeding that 7.5% AGI, right? Like, what does that look like so that we can take advantage of that itemized deduction, right? And again, maybe it's also that bunching. So that's the action point here on this. The other action point is at the bottom, right? Is that your clients that are 65 and over could have a $46,700 total standard deduction. That is a huge number, and it allows you to do planning for those people. So imagine this: you have $125,000 of income, you're 65 and over. That 125 is really like 75, okay? Because there's basically a $50,000 standard deduction, and at $75,000 of standard of income, right? You have another 25,000 that you're at the 0% capital gains bracket, right? You another 25,000. That's cool. Maybe start selling some of your Apple at a 0% capital gains rate. Or, maybe you then do some distribution planning or even Roth conversions and take advantage of that very low number, because at up to $100,000 married filing joint, you're at 12%, right? So that capital gain 0% bracket sort of closely follows that 12%. And there's a lot you can take advantage of down there, right? So those are some examples of how to be thinking about this standard deduction, right? So in line with that, let's create a plan for our senior clients, right? Let's think about who these people are, and do we do some outreach for them, right? Do we want to try to help make sure that they can take advantage of this enhanced senior deduction, right? The RMD strategies, right? To make sure we think about using QCDs, and those need to be done before the RMDs. And then estate planning with the higher exemption, and then looking at these big RMDs that are coming in, because we have 3 years, 3 years of an elevated market. And so your clients' RMDs might be 20 to 30% higher this year. What are we doing with those excess RMDs, right? So yeah, okay. So let's create a senior outreach plan. How are we doing it? Maybe it's when we meet with them, we have a special checklist. Maybe we send an outreach to them, right? What are we doing for these seniors? And if you're like, whoa, 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 wait a second, like I don't even know who these people are, that's why you have Holistiplan. You have a dashboard. You can filter, right? You can filter age 65 or over. You can filter by AGI, right? You can filter by these things and figure out who those clients are, and then go after them. All right, next slide. More on our seniors, right? No, the SALT deduction. So we talked a little bit about this. Huge tax torpedo, right? Imagine this thing like swimming through the water. It's freaking huge, okay? $500,000 to $600,000 in income, married, filing joint, or single, doesn't matter, and you could lose a $30,000 deduction, go from 40 to 10. You're going to have a very, very unhappy client if you don't warn them and they're in that weird $500,000 to $600,000 zone, which is crazy. If they're way under 500, you don't have to worry about it. If they're over 600, you don't have to worry about it, right? It's 500 to 600. What a headache. What a headache. But that's why I have the software, and that's why I have the disclosures, right? Good. Next one is the permanent charitable deduction. So in some of our polling, we asked you and you're like, hey, I'm a little bit confused about charitable deductions. Of course you are, because they keep changing the rules on you. So what's the bottom line? They bifurcated. If you itemize, there's one rule. If you take the standard deduction, that's another rule. Standard deduction. So what happened is 90% of people taking the standard deduction, they stopped making those charitable contributions, and the charities suffered. So now you can take the standard deduction and you get $1,000 if you're single. You get $2,000 if you're married filing joint. Keep those receipts. Remember, I've been talking about that. Keep those receipts. Make sure your clients know, right? Because they might not even know about this. They're just writing out those checks, not even telling you or telling their accountant, and now they've lost that $2,000 deduction that they could have, right? Now it's got to be cash, and it's got to be to a public charity. So it can't be to a DAF, it can't be to a private foundation, it can't be appreciated stock. It's got to be cash to a public charity. They want it going to good use. So that's if you take the standard deduction. If you itemize, then there is a 0.5% AGI floor. So now we've got 7.5% on medical, we got 0.5% 5% on charitable. Okay. And so that's where some people were saying, oh, do your charitable deductions in 2025 and take advantage of the more favorable rules. Well, 2025 is behind us. And so now we have to deal with this 0.5% AGI limitation on the charitable. Okay. Next. Permanent child tax credit increase. Here you go. Big thing here. It's adjusted for inflation, and there's a refundable portion of $1,700. And by the way, this goes up to $444,000. You can still qualify for that child tax credit, which is like crazy. Remember, we like credits over tax deductions, right? Credits are much more powerful. You get them dollar for dollar. And this is, quote, permanent, right? Good. Next, temporary new Trump accounts. We're going to be hearing a lot about this over the next 6 months. What is the bottom line on the Trump accounts, right? What's the bottom line? Here's the bottom line. Think about the Trump accounts in two ways, right? Two ways. Number one is the $1,000 pilot program. A kid born between 2025 to 2028, $1,000, they have a Social Security card, which they get in the hospital, right? Okay, so let's take our $1,000 and run, right? Let's take our $1,000 and run. That's my answer to that, okay? Now, by the way, Greg, are you going to be able to qualify for that, right?
I was 13 days away.
No,
It's all
Greg, that
right. It's
13
all right.
days.
I got my child tax credit for 2024. I'll take it. I'm going home happy.
Okay, you realize that philosophically, I do not believe that you should have a child tax credit. You realize that, don't you?
I don't realize that, but we'll talk about that.
Greg's like, what are you talking about? I absolutely earned every bit of that child tax credit. I mean, I just like, I cannot believe that people can make up to $444,000 a year and still qualify for a child tax credit, right? Like traditionally, these tax credits were for people that did not have like a ton of money. Greg's like, stop right there. I don't have a ton of money, right? I get it. We'll talk about this offline in the Dominican Republic. Okay, so Greg didn't tell you, but we're going to the Dominican Republic this weekend for a reward trip. We're very excited. Okay, so we got the $1,000, 2025 to 2028. We're gonna claim that. Okay, that's when the child has to be born. Now the other part is basically think of it as like a Trump IRA, right? Think of it as like a Trump IRA because you can fund it with $5,000 a year adjusted for inflation. That's the friends and family contribution is what I call it. Then there's $2,500 a year from your employer, right, for your child, right? And then the third way is the government and charitable contribution. So there's three ways to contribute to the Trump accounts. And then the fourth way to make money in the Trump account are earnings, right? Earnings on that money. So there's four ways that these accounts can grow. And what does that mean? Well, just like with IRAs, when you're mixing after-tax money with pre-tax money, right? In these IRAs, is the distributions then are going to be like pro-rata distributions depending on the tax treatment coming in, right? So earnings are going to be taxed, right? But other contributions may not be taxed, right? And so we've got to watch sort of how that gets handled, the distributions. Right now, we are thinking that Roth conversions will be allowed in connection with the Trump IRAs. That is cool. And we're also thinking they're going to be RMDs. There are exceptions to penalties, just like with regular IRAs for first-time home purchase and college costs. So again, you're seeing when we get additional guidance, some was released just last month, you're seeing it's looking more and more like a traditional IRA, right? So what's the idea here then? Is do we want to use this for education? Probably not, right? The 529 is probably still the winner, right? But what we want to think about when we go to the next slide is for those very wealthy families that you have that are always looking for the angle. And they're like, they're just so smart. They're smarter than you. They're like, how are you going to help me? Right. And you're like, I have this great idea. Trump account. You can put in $5,000 this year, adjusted for inflation. And now you're essentially pre-funding your child or grandchild's retirement up to the year before their age 18. Okay, is you can push that money in not to age 18, the year before age 18. But you put in that 5,000 every year. It's going to be adjusted for inflation, so it's going to be a little bit higher. There could be other contributions coming in from employers, whatever. But That is huge because without a Trump account, you need earned income to fund your IRA. And so unless you do what I did, which basically put my children to work by the time they were like 6 or 7 years old, literally, I hope there are no IRS agents on the phone, but my kids legitimately worked. They were models, they were greeters. I had them in like publicity shots, right? And then by the time they were 10, they were photocopying, all kinds of stuff like that. And then they were helping to write articles for me and do research in middle school. So my kids literally had earned income, but most kids do not, right? Most kids do not, or it doesn't start until they're 17 years old and they have like a real job, right? And so what you can do is literally from the time this child is born, because you don't need earned income, you start funding a Trump account up until the age of 18, the year before. So what does the data show? Is that with those $5,000 contributions, the account could grow to $1.1 million with those contributions at age 28. That is cool. And your wealthy clients will like that idea. Okay, will like that idea. So that's the idea. That's how we're thinking about Trump accounts. All right, permanent lifetime gift to the state tax exemption. Super exciting, $15 million each. Here's the thing, do not get complacent, right? Next slide, do not get complacent. We have up to 20 states that have some type of estate or inheritance taxes. Okay, we have couples that are growing a lot with their estates. So we want to get the estate value down. We want to get appreciation down, and we have flexible trusts. And these flexible trusts allow us to have our cake and eat it too. So let's have our cake and eat it too. Maybe we open a family limited partnership, maybe a SLAT, maybe QPERT, SCRATs, right? So I'm not saying give all of it away today, but if you have clients that are worth 10, $20 million, let's not play roulette with their lifetime savings. Maybe we set up some of these more flexible trusts, and I think that could be very helpful. The next slide sort of lays this out for you. It's a little graphic that we created. And here you see again, $0 to $15 million. This is our foundation, right? This is getting your core documents in place, making sure Aunt Trudy isn't the executrix and yet you haven't seen Aunt Trudy in 20 years, right? And then growth and flexibility, 15 to 30 million. This is your slats. This is your grads. Let's do some aggressive gifting, right? So let's see what we can do here to sort of stem the bleeding, stabilize the situation. And then $30 million up. Let's roll up our sleeves. All bets are off. And let's go to town and start getting some of this money out of our estate, right? Next slide, temporary tax deduction for tips and overtime pay. I mean, unless your clients are like in Nevada and, hospitality, whatever, for the most part, I would say this is not a biggie. But if you have clients in those states or in these professions, then yeah, let's pay attention to this. And again, you want to make sure you don't run afoul of those maximums. They phase out from 250 on and capped at 12,500 for single, 25,000 for joint for overtime pay. And remember, it's only on the overtime part, right? Not on the base pay. And then you see it for the tips as well up there, okay? The numbers. So let's pay attention to this. And again, Holistic Plan can help you filter this out. And then we created a little cheat sheet for working clients and families, and some lists to go through. So for those of you who have clients who are working, collecting those W-2s, maybe you put together, again, a little checklist that you send to them, or you set this up when you're sitting with them, right? Lots of ways to do this outreach. And so we're thinking about making sure that they're funding their retirement plans, right? And then the next slide, using our Roth conversion strategically, dependent and family planning opportunities like the child tax credit that Greg was able to claim, right? Flexible spending accounts, Trump accounts, 529s, right? And so this is just a little cheat sheet for you with those clients, right? The next one is business owners. This is just a world unto itself. If you have clients that are small business owners, you just need to stop. Like, they do that with like 3 or 4-year-olds. What is it like? Stop something and roll, stop, drop, and roll, right? If you see business clients, stop, drop, and call the CPA, right? Stop, drop, and get the CPA involved. Do not wait until December. That's too late. If you've got these clients, start having those conversations now. What are the action items besides having the conversation? It could be a change of entity, going from, a C Corp to an LLC, or going from an LLC to a C Corp, because then you can take advantage of the qualified small business stock exclusion, right? Like lots here. Maybe we want to go out and start buying some equipment because we've got all these depreciation opportunities, right? Lots here. And then you see them also on the next slide also, right? And so let's pay attention to these depreciation opportunities, interest expense deductions, qualified small business stock, right? All of this, and let's get the accountant involved. This is too much for you to handle. Next, the QBI deduction. So this is another one. This is beyond your pay grade. So again, you can do this search in Holistiplan. You can say any client with a Schedule C, and you get a list of them, and then you can reach out and talk to them about these business opportunities, right? And have a little cheat sheet or handout in connection with it. Maybe you do a webinar on it, depending on your client base. And then we want to create a plan around this. And so that's the next two slides. Again, I'm giving you some of this material right up front. It's create a plan for business owners. What are we talking about, right? We're talking about depreciation, interest expense, R&D, qualified small business stock exclusion on the next slide. Also, let's set up the retirement plans for them. Have you talked to them about cash balance and deferred comp plans? Because that cash balance and defined benefit plan, some of your clients could put away $600,000 or $700,000 in 1 year, right? You want to make sure you're talking to the right clients about that. And then this last two slides here in this section are the maximums for the different OBBA deductions. So this one's for individuals, and you see there, Greg was able to qualify. Here's married filing joint, up to $444,000 a year. I have no doubt that Greg was right at the cusp of that $444,000, right? And I'm happy for you, Greg, right? I'm happy that they've expanded this so that you can still qualify for this, right?
Yeah, I had to really maximize that cash balance bank contribution, but we made
Did,
it.
did you put $700,000 into your cash balance plan this year too?
Yeah, just really, really pre-funding that.
Well, that's actually genius. Is you put 700,000 into the cash balance plan, you drive down the income so that you can qualify for the child tax credit. That is absolutely brilliant planning. And did you use Holistiplan to model that out?
Of course, absolutely.
Yeah, I think that's absolutely genius. And also remember, Greg, the child tax credit is adjusted for inflation. So, I mean, depending on what your raises and bonuses look like going forward, you'll hopefully be able to continue to qualify for this, right?
Uh,
That's
Absolutely.
great. That's great. So good. So we included these charts because, picture's worth 1,000 words. I can't remember all these maximum limitations. I mean, Greg can because he's able to claim the credit and stuff, but I can't remember all these. And so it's super helpful. Okay. Good. All right. What's the bottom line here? No more drive-by planning recommendations. Greg, what type of car is that? I don't even know. It looks like a fake car. I think it's a fake car.
Yeah, that is I'll call it the AI slop car.
That's an AI slop card. No, no AI slop. All right, let's go to the next slides because Greg told me I had to be done by now. And look at this. We're still running over a little bit. All right, let's look at Secure Act 2.0 and the pitfalls of the large traditional IRA. And so the next slide is just a little bit of reminder of Secure Act versus Secure Act 2.0. So remember, Secure Act was 2019. And the big thing about the Secure Act, right, is inserted that 10-year rule. I got to tell you the truth. There's all this stuff that Secure Act did. I don't even care. I don't even care. All I care about is that 10-year rule. That has changed everything with your planning, with IRAs, with large portfolios, with like intergenerational. That Secure Act, and by the way, that's a lie. Secure Act is a lie. It's Insecure Act. It's Unsecure Act. It's Steal Money from My Clients Act. That is truth in advertising. This is a lie. Next time you do one of these slides, I want you crossing that off in big red. Okay, I'm not even kidding you. If I see Secure Act one more time, I'm gonna be very upset. Okay, so that's Secure Act. Okay, then Secure Act 2.0, big thing there, right? Because there are a lot of little kitchen sink provisions, right? Is age 73 and age 75. Why does that matter? Because that then creates some complacency. Your clients don't think they need to worry about this. Those IRAs grow and grow and grow. I think it's a trap. Secure Act 2.0 is a trap because Secure Act original OG is like, oh, 10-year rule. And then they're like, oh, how do we sucker people into this? Oh, 2.0, you don't have to take your distributions till age 73, age 75. By the time your client takes their distributions, now their IRA is literally doubled or tripled in size, and the government gets more money. We are smarter than that. All right, next slide. Understand the Secure Act. Basically, we just talked about that. Key thing here is expanding 529s, right? And they continue to do that in Secure Act, making it available for K through 12, and now with OBBA, making it even more available, $20,000 for K through 12 available, and then also for post-credentialing, so that even somebody like me, I can go and do CE and charge it to my 529 account. And so that's a key provision there. Okay, so let's go to the next slide. Here is my bottom line, right? This is what I care about nope, next one. Sorry, Greg. Is this large, expensive. This is an estate tax, right? Let's call it what it is. It's not Secure Act, it's Insecure Act, and it is an inheritance tax on large IRAs. And so we as a profession need to step up, roll up our sleeves. You will close millions of dollars of business just on this, just on this. You get really good at this. We are helping you get good at this. And then you will get more assets, more wallet share, clients that are loyal because you need to do this analysis every year, and you will save them millions of dollars. Okay. And so that is a key action item for you, is listen to these webinars, get really good. All right, next slide. Strategies for retirement account owners. Look, these, these, but you might not think about them in like one organized way. So here they are on one slide. When you have a client that comes to you and they say, oh, I have a large IRA because I bought NVIDIA, at the open, 10 years ago, whatever it was, right? Is you're like, okay, like here are some of your options. But at the end of the day, right? Like what's the option that makes probably the most sense in most instances is number 4. Let's do these Roth conversions, right? Let's do distribution planning, right? Which is actually trying to draw down those traditional IRAs. And yes, it can be life insurance, right? Yes, that's a possibility as well. Okay. Okay. Yep. And now the beneficiary. So this is post-mortem planning. So now you have somebody coming to you that has the inherited IRA, and what do? And here are some ideas. I hear about people taking even amounts every year. No, I mean, that's the lazy man's way to do this. You have a holistic plan, roll up your sleeves. Let's sit, let's talk to the client, find out, oh, you're retiring in 2 years. Maybe that's when then we start taking these distributions. Oh, you're moving to a low tax state like Florida. Maybe we wait till next year and start doing these distributions. So let's have these conversations. And let's figure out how to model this out during that 10-year period. This is the importance of creating a Roth conversion plan. I have 2 slides left and then Greg gets to go. But what's the bottom line here? When you model out the Roth conversion plan, literally, what are we doing? We're driving down lifetime taxes by $3.5 million. Okay. We're driving up the Roth balance by $17 million. How does this client not hire you? These are real numbers. These are real numbers. And guess what? When I show this to somebody, I get hired. I get all their money. They pay my fees. They recommend their friends to me. That's how you're going to win, right? That's how you're going to win. I know you think we win on Greg's good looks and charm. I know that. I know what you guys are thinking. But I mean, I guess it helps a little bit, right, Greg? I mean, are you charming? I think you're charming, right?
Somebody can stand me,
I love that. Your 3 amazing children and your amazing wife. All right, let's go to the next slide. Planning tips around IRAs. So summing it up, let's prioritize Roth conversions. Let's also do distribution planning. Maybe it's Roth conversions. Maybe it's also taking distributions from those traditional IRAs. Maybe it's doing them at the same time, right? And also that can include QCDs. Yes, it can. That can be helpful. Let's look at our estate planning and let's not be lazy about this. These flexible trusts, these slats, you can do so much. You have your cake and eat it too. Okay. And then distribution sequencing and asset location, right? And let's not go soft, delayed RMDs. Oh, I can wait till 73. All that means is that IRA is going to double during that period of time, and we're going to have an even bigger problem. So you need to hire me today, okay? So I can do the tax planning. And with that, Greg, I know I went a little bit over, and my
No, I think you
apologies.
did great.
But you are up.
Oh, perfect. So What we want to move on to is really just this concept of unfreezing large taxable accounts. Like Debbie said, this is something that we see with so many prospects and clients. I think you'd be hard pressed to find a prospect that doesn't come across our desk that isn't dealing with this exact issue, and it's probably the primary reason why they're seeking out an advisor in the first place. So we see this day in and day out, and there's a couple of reasons for it. So let me move through here. What is a frozen portfolio? We've heard this term. I'm sure you've heard this term. It's the assets itself within the portfolio, or maybe they've gained to the point where the client does not feel comfortable selling them. There's very little liquidity within the portfolio. Rebalancing is off the table. And there's no way to change strategy within the portfolio because they can't think of anything except, oh, if I sell this, I'm going to pay taxes. There's a couple of different scenarios where I've heard this term used before, which I think applies in the same way. Sometimes you hear direct indexing accounts that are frozen because they really can't do much from a tax loss harvesting standpoint. Within the portfolio. So you're sitting there, you have a managed portfolio. It really can't be sold. You can't realize any losses from it. And it's sort of at a standstill. So we know how this occurs, but going through it quickly, embedded capital gains, just over time, decades. In this case, really though, it's more like years. If clients pick the right stocks over the past 4 or 5 years, they're sitting with 80, 90% appreciated positions that they have no interest in selling. They feel so uneasy about it. And we've seen it so many times too, where even when clients sort of set an exit point, I want the price to be at X amount. But you get to that point, and then they say, well, I'm going to have to pay taxes. Let's add another 20% on top of that to cover the taxes, because then that'll make me feel happy. The cycle continues ad nauseum. They never act on it, and they're stuck there. The problem continues to compound. So it could be from concentration risk. Sometimes you have employees who received employer stock throughout their career, and this could even lend itself to emotional attachment. I've seen it many times. Clients feel like they've owned it forever. It's the company that made their career, in many ways made their life. So they have a very emotional attachment to it and are very hesitant to sell. Um, you can see that with inherited positions as well. This is a stock my father bought for me, my mother gave to me, my uncle gifted to me, so they hang on to it. But moving on, there's no tax lens in planning. So in more often than not, clients are coming to us because no one's ever been there to tell them what they should or shouldn't be doing in the meantime. On the flip end of that, your clients come to you, prospects come to you with horror stories. Oh, I'm paying a huge tax bill because I sold something. I didn't realize it was going to be taxable. So no one's in their corner with them, helping them evaluate those long and short-term tax outcomes. And of course, lack of systematic rebalancing. Again, especially as so many of these key positions have just run rampant the past few years. We've got, three years in a row of double-digit returns in markets overall, and a handful of positions and stocks and companies that have performed even better than that. So they haven't taken the time to systematically rebalance, lock in those gains. So that leaves them where they are today. And the results are, they're really kind of all over the place, but the portfolio can't be managed properly. There's so much fear embedded, in the clients, in the market overall to realize those gains. No coordinated advisor guidance. That's just going to lead to so many issues down the line if you're trying to set up the portfolio for success long term. Do that asset location, which we'll get to in a little while, in a couple of slides. Taking advantage of those estate strategies that you might want to. It's just going to do nothing but work against those strategies or limit your ability to carry them out. Missed opportunities to reduce future RMDs. Manage the concentration, improve long-term after-tax returns, so that the people sit there stuck with these large positions. Maybe they're dividend paying. Maybe it's a large mutual fund holding that they've just been buying and buying and buying for decades and decades, and now all of a sudden they're stuck with a capital gain distribution that is almost feels like an RMD every single year, but they have nothing to show for it. No cash, nothing in pocket. So liquidity challenges, certainly this is one. And many come to that point. They feel like they just need to wait. Oh, I just need to hold this until the end. So every reason comes into mind as why they can't possibly sell this. They need to just hold it until death, get the step up in basis when they gift it to their children. So, what is it that we can do to help clients break through this? This is, like Debbie said, this is why they're hiring you. This is why you're in their corner, is to get them through some of these hesitations and get them through. So tax loss trading, doing this proactively. And I know what you're thinking. What losses can I possibly take from my portfolios? My client portfolios are so appreciated, especially over the past 3 years. But maybe digging down into that lot level, maybe there's lots that have losses embedded that you can take. And we've seen this almost every single year for the past 3 years, even as the overall market has ended, very positive, year beginning to year end. There's always those downturns. So looking for opportunities in those downturns, having a plan in place so that you can act quickly, from an enterprise level, to make sure that you can take advantage of those losses when they present themselves. Leveraging the capital loss carry forwards. It's not enough to just leave them there. Let clients know that they're there for use in some future far off world. Like, no, those are the losses, the carry forward losses that you're going to use this year, because it's not going to do you any good when the problem of highly appreciated positions just keeps getting worse and worse. Those carry forward losses are going to become less and less of a solution every year you move forward. So using those in the current year, not allowing them to just continue to roll forward. Capital gain harvesting. This is kind of on the flip side of things, but so many times we see situations where, had there been someone in their corner just giving them sound advice, using Holistiplan, using that scenario analysis, it could have been the case that they could have just been taking small chunks of that position year after year, taking advantage of those lower capital gain brackets. Depending on the situation, they could even take advantage of the 0% capital gain bracket. I know that ends pretty quickly for most folks. So, right around that $100,000 mark is when they're going to hit the top of that bracket. So, not for everybody, but at the very least, taking advantage of that 15% bracket to the best of your ability, spreading it out over a period of years, and just getting them to the point where they're satisfied with diversifying. Asset location. This is something that you're going to do with your clients coming on board. Hopefully, at that point, you have some flexibility. But if not, just ensuring that going forward, what are we going to do? We're going to put our high growth investments and assets in tax deferred accounts where we aren't necessarily concerned about if it explodes overnight. We can always rebalance tax efficiently, and also putting any income producing positions in those accounts as well, unrelated to frozen portfolios, but always a good rule of thumb there. And then in our taxable accounts, maybe that's where we locate more moderately growing investments. Maybe take a more moderate approach, ensure that we're not creating this problem all over again in another 5 or 10 years. And another thing to consider is long short funds. I'm sure you've probably heard about investment companies that are doing these types of funds. And the key really is creating that economic benefit and creating losses. So one company in particular we've been working with and really leaning into in 2025 is AQR, Advanced Quantitative Research. This is these types of strategies they've been implementing for decades now, about 25 years, and these types of strategies are just going to become more and more prevalent in the coming years. We've certainly heard about big institutions, small firms, rolling out these types of strategies, making them available to retail investors, bringing down minimums to put into these types of strategies. But this really takes the direct indexing strategy to the next level, establishing that long short, and in many cases generating really significant tax losses in the early years and ongoing for clients. So, in many ways, this is a capital gain deferral, but that could be the solution that a client is looking for. Perhaps they're comfortable with it being more of a deferral than a straight loss, but they get to diversify in the meantime. So giving them that opportunity, allowing them to take some of the risk off the table of holding that large concentrated position, that frozen portfolio as is. could be the solution that allows them to go forward and get to the point of comfort. So really something that you're going to be hearing a lot about. I would just stress that you need to be understanding. You need to read the ADV for the investment company, whatever company that your client's going to end up invested in for one of these long short strategies. You really have to understand who the company is, what history they have, what track record they have as well, because the economic benefit is really key here. If you don't have that as an investment firm and you're generating these tax losses, well, maybe the IRS is going to come in, take a look at that and say, you know what, this is really only for the purposes of generating capital losses. There is no economic benefit here. So, keep really, pay special attention to that, and, lead your clients in the direction of sound firms that have a good track record for that economic benefit portion of things. And that's where we are for our frozen portfolios. Just keeping that in mind. I think again, this has been a huge point of emphasis in recent years, and I think it's just going to continue to be. So, moving on to some 8 key strategies and tax implications of possible market volatility in 2026. Like we said, 2025 certainly had a period in April, maybe for expected reasons, for unexpected reasons. That's beside the point. Almost every year there are intra-year declines in double digit in many cases. So there's very likely to be a period of decline and volatility in 2026. We have 3 years of positive markets, and the possibility of there being a 4th year in a row. And the percent is escaping my mind, Debbie, but I want to say it's something like 5% chance of. I know we just discussed this yesterday. Something like 5% chance of the 4th year in a row also producing something a similar positive return.
Yeah, similar return, I would agree 5%. It depends what data you're looking at, but basically it's like 50% having like a positive return this year. It's certainly at the very least, we need to be prepared for the volatility at the very least, right?
Exactly. So we're going to give you 8 key strategies, to take into account during these volatile markets and when volatility presents itself. So for anyone contributing to retirement plans, this is especially prevalent for, maybe business owners, as we discussed, people who have some flexibility in how they can make contributions to retirement plans. But even for your employed clients, if they have the flexibility to increase those contributions during those down markets, that's an opportunity to take advantage of the down market, realize all that appreciation when the market does recover within their retirement account. So that's something we recommend to all clients. That's part of our we call it our bear market action plan, which we'll take a look at in a couple of slides. But as soon as we see the market is coming down, we make that recommendation to any and all clients that are contributing to retirement plans. Roth conversions during market pullbacks. This is something we did in 2025, we did in 22, we did in 23. So we do not forget this. It's why we do our distribution analyses, Roth conversion analyses early in the year, because we want to be ready for those market pullbacks. We want to be able to identify positions within accounts that are especially depressed during that period of volatility. We can convert those in kind. We can convert stable funds as well, and buy and sell across our traditional and Roth IRAs at a later date when something's recovered or clients feel more comfortable. So just in general, taking advantage of those market dips with the possibility of realizing the bounce back within the Roth IRA. Tightening cash flow. Don't want to say that this is inconsequential, but you'd be surprised how many clients this applies to during volatile times. Perhaps people who take lump sum IRA distributions for the year, if they take their RMD right up front in the year, or it's looking like they're going to want to take it during that time of a market downturn. Just delaying that. Pushing it out a little bit, maybe spreading it out, taking monthly distributions instead of a lump sum distribution can really go a long way to ensuring that they aren't totally at risk of that sequence of returns and taking that distribution while the market's at its low. And of course, confirming they have liquidity to do so. That's something to do when the market's feeling good. Let's make sure that we have that liquidity bucket built out. Delaying retirement, again, this is another one for your working clients. Maybe they're planning to retire, or have a rough estimate in mind. But if there's an opportunity, if they're able to continue working, and if it's something that they can put in place, definitely recommending delayed retirement. That can do a lot to just improving the longevity of their financial plan over time, by delaying the use of those retirement assets, the portfolio assets. Investing idle cash, if it's sitting on the sidelines, this could be the year. 2026 could be the year. We've been doing this year after year, just making sure that clients are putting idle cash to work. We don't want it sitting, especially as yields are set to decline or will most likely decline. Now could be the year to put it into the equity markets if an opportunity presents itself. And of course, rebalancing portfolios. Always need to take the opportunity, to rebalance portfolios, and look ahead to do so, because when this again comes back to the frozen portfolio. It's really the same issue, is that clients are hesitant to during periods of really strong markets, for a variety of reasons. Maybe they just like the positions they're in. They're hesitant to sell them. They're hesitant to realize the capital, the tax impact. So use these market dips to their advantage. And you'll have to excuse me. I just noticed that my numbering is out of order, but we're continuing on with our strategies. So getting more aggressive in our asset allocations, making those long-term bets while markets are down, while companies are down. And then, of course, your gift and estate planning, GRATs, CLATs, IDGITs, which that is a shortened version of intentionally defective grantor trust that I heard for the first time this week. So we are always learning something new. They tend to make sense when assets are more depressed. You can realize all that growth within those trusts. And then, of course, cash transfers, charitable remainders trusts. Those make sense when assets have appreciated. So 5 solutions in a volatile market, making lemonade from lemons. We are almost through to the end here. So what are we going to do? We're going to stay diversified. We'll focus on domestic equities. That's something that we've had a tilt for in recent years and continue to. Of course, we're expecting the volatility. That's the price of admission for higher long-term returns, for staying invested in the market. Maintaining the long-term focus, block out the noise. We see this every year. Basically, as long as I've been in this industry, every year has been forecasted the end of the stock market's beneficial run. So here we are. Continue that long-term focus. Get the tax and estate planning done while asset prices are lower. Take advantage of these opportunities. And of course, capital simply gets redistributed. There's always a way to make money. You just need to be calm. You need to be creative. Perhaps it's not return in the portfolio. Perhaps it's tax savings, or some other way. So of course, this is what I said. We have a bear market action plan. So we implement this exactly when markets start to come down. This eliminates any guesswork from our team, and hopefully for our clients, as they see that we're prepared for this. We understand what this means to them and what opportunities it presents. So it's a series of announcements. We have videos that we send out. We will do, a webinar if the market is down 10%. That's it. We do a webinar. We explain the situation. We explain our thoughts on the current state of things. We'll send out risk-aligned check-ins, get a temperature check on how clients are feeling about markets. We'll do tax loss trading reviews. Do a proactive outreach for clients with excess cash. See if they want to potentially put that to work. We'll, of course, revisit our models, see what ideas may make sense, expedite dollar cost averaging for new clients, review our hedge funds, or hedge mutual funds, to ensure they're still making sense. Roth conversion opportunities, as I mentioned. And we would really recommend everyone build something like this. Doesn't have to look exactly like ours, although I think ours is pretty good. But go through this, see what makes sense for you, for your clients, adding that personal touch for your firm, and just make sure that when the time comes, because the time will come, that there's volatility. You're ready to go. You're ready to move. There's no question. There's no guesswork. And with that, moving on to key considerations as interest rates are set to decline. And I'll hand this back to you, Debbie.
Oh, I thought you were doing this one.
Oh boy, here we are. Well, I can continue on. As Debbie said, we see what's going on. We see the headlines, what 2026 holds for us in terms of the balance between politics and monetary policy. Really, I think, like we said, seeing through the noise, what is likely to happen this year? There's likely to be decrease in interest rates. So what does that mean for clients? Perhaps it's time to, really start pushing into that intermediate duration fixed income, just taking a temperature check on the way their portfolio is structured. Of course, taking a look at buffered or hedged equity strategies. So, taking advantage of those where appropriate, maybe as an alternative to fixed income, and of course, looking for money in CDs, money market funds. Clients are always saying, "Oh, I got a great rate on this CD." Well, the next time it matures, or that money market account, that online savings account, that's not likely to stick around. Rates are coming down. What are we going to do while also protecting
Greg,
you? Yes.
Greg, we're running out of
Ding, 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 ding,
time. Ding,
ding.
ding, ding. I'm hopping in here, Greg.
Go
All
for it.
right, okay. So here's the bottom line here is your clients have money all over the place. They're in bank accounts, money market, trying to get their 4%. It's slipping through their fingers because interest rates are going down. So we can leverage Plan to do Schedule B analysis for outside accounts, wallet share. And here is an example of this. And this was actually our brainchild. I talked to Roger Pine about it literally over a weekend, 2 Augusts ago. So leverage Plan to create that wallet share and to chase down those extra assets. Next slide, be proactive in that client outreach, whatever it is, right? Whatever it is, feel free to do that and use the Plan resources. And then bonus materials. So we gave you an announcement that we send out to clients in the beginning of the year, early 2026, and how we leverage Plan and the work we're going to do for them. So that's available to you. And then the next slide, yep, is our annual service calendar. And again, some of that tax planning work we're doing. And so with that, then I have been answering questions diligently throughout. I'm very proud of myself. I know Greg was also. And so the next slide is for those of you who have not signed up. 2026 is your year. You need to be doing tax planning because that's how you're going to bring in your assets and keep these clients. And so with that, I just want to mention one thing real quick. We've got this IRA question that's come up. I answered it. It came up again really quick. You got to think about inherited IRAs in two ways. This is a non-spousal beneficiary. Is a 10-year rule. You can take it out any way you want in the 10 years. It's just at the end of the 10-year, you have to be at zero. They don't care. They don't care. You can take it any way you want. However, if the account owner, the IRA owner, the deceased IRA owner was already taking RMDs, then you also need to be taking RMDs during that 10-year period. So then you're doing both, right? You still have to empty it out to zero by the end of the 10th year. And arguably that's the 11th year, but whatever. And you got to be taking those RMDs, which is an annual thing. There was a ton of confusion about it. The IRS dragged their foot on it. Anyway, that's it. Answer that question live. Alana, back to you. Thank you, everybody. You've been a great audience and listeners. Fantastic questions. And thank you, Greg. Everyone's awesome.
Yes.
Thank
Thank
you.
you so much, Debbie. Thank you, Greg. Again, thank you to everyone who asked questions. Thank you to Debbie and Greg for answering all of those. I know there were a ton. And then Madeline and Tracy from our team. Thank you guys for knocking all that Q&A out. I think that is like one of the first times I've seen the Q&A almost like zeroed out by the end of a webinar. Great work. Thank you to everyone who stayed on. I really sincerely appreciate you being here and spending an hour of your time with us. I know that there are a lot of things this time of year that are worthy of your attention. So I sincerely thank you for spending an hour with us here today. We will see you next time.
Bye, everyone.
Bye, everyone.